Most investors right now are focused only on the Middle East war and the risks in the private credit market. But in my opinion, there is something that could be even more dangerous for the U.S. market. That is the labor market. Our goal with stock and crypto investing is to grow our assets. So why do we need to understand the U.S. labor market? There are two reasons. First, the U.S. labor market is directly connected to the U.S. economy. Second, it also influences monetary policy. So if the U.S. labor market continues to weaken, we need to think about what could happen next. Hello everyone. Today, I want to talk about U.S. employment indicators. Most investors are currently paying attention only to the Middle East war and the potential crisis in the private credit market. Many people are wondering when the Middle East war will end. Others believe the private lending market could eventually lead to a financial crisis. However, I believe the biggest risk in the U.S. market right now could be the labor market. Recently released U.S. employment indicators, including the unemployment rate, appear relatively strong on the surface. But when you look deeper, the U.S. labor market is starting to slow down and show cracks. That is what we will discuss today. Employment data is important for another reason. It affects whether the government or the Federal Reserve decides to print money. When employment data is strong, policy decisions change. When employment data is weak, policy decisions also change. If we understand these signals, we can better anticipate whether liquidity will increase or tighten in the market, and that helps us build investment strategies. Even if you look at the recently released data, employment does not look bad at first glance. Even over the last 9 months, it seems relatively stable. But when you look closely, the labor market has become rigid. Let us start with the first point. The U.S. labor market has become rigid. What does that mean? It means workers are not quitting their jobs. At first, this might sound like a good thing. People may think that staying in a stable job is positive, but the reality is different. Because the labor market feels unstable, workers are losing motivation to switch jobs. And unemployed workers are finding it harder to re-enter the job market. One important indicator economists watch is the quit rate. This means the percentage of workers who voluntarily leave their jobs. If workers trust the labor market, they are willing to quit and find a better opportunity. But if they do not trust the market, they stay where they are. According to recent data from the U.S. Department of Labor, the voluntary quit rate in January was only 2%. In sectors like government, finance, and manufacturing, it was below 1.5%. This means workers do not have confidence in the labor market. This trend is especially noticeable in government finance and manufacturing. In other words, even workers in stable jobs are not willing to leave. Currently, except for the healthcare sector, job growth in the U.S. is very limited. At the same time, concerns about mass layoffs due to AI are increasing. A lower quit rate means workers stay in their positions longer. This naturally means fewer new job openings. This makes it harder to find jobs in sectors like government finance and manufacturing. College graduates may also struggle to find jobs, and that could lead to higher youth unemployment. We are already seeing many discussions in the U.S. about job difficulties for Gen Z graduates, so a low quit rate is not always a positive sign. When labor mobility decreases, productivity tends to fall. In a healthy labor market, talented workers move from weaker companies to stronger companies. This movement improves productivity. But if mobility decreases, inefficient companies keep their employees. At the same time, innovative companies struggle to attract talent. Over time, this could slow down productivity across the entire U.S. economy. And if the slowdown becomes severe, it could lead to economic recession. Another issue with a low quit rate is that workers cannot move to better jobs. In the United States, most wage growth comes from job switching. When people move to better companies, their salaries increase. But if fewer people switch jobs, companies feel less pressure to raise wages. Workers also lose bargaining power. Recent data already shows wage growth is slowing down. From an inflation perspective, that may be positive, but from a labor market perspective, it is not positive. Workers are becoming more focused on protecting their current jobs. That is because they do not trust the labor market, and that increases the risk of an economic slowdown. The second factor is Trump tariff policy. Since President Trump took office in 2025, tariffs have become one of the strongest policies. Because tariffs can change suddenly, many companies are delaying hiring and investment decisions. When tariffs are imposed, companies face uncertainty about raw material costs, supply chains, and product pricing. They cannot accurately predict future expenses or revenues. Because of this uncertainty, companies choose the easiest decision. They hire fewer workers. Some companies reduce recruitment. Some companies lay off workers. Hiring decisions are one of the fastest ways for companies to control costs. Companies may also delay plans to build new factories, expand production, or increase inventory. Even if they had investment plans before tariff uncertainty can force them to reconsider everything. Because of this, many analysts on Wall Street believe tariffs are contributing to the slowdown in the labor market. Some estimates say the effects of these tariffs may appear between May and September this year. The third factor is AI reducing hiring demand. According to the Federal Reserve's Beige Book, many companies are using automation and AI to improve back-office efficiency. Some banking executives warn that this could reduce labor demand in the future. Many U.S. big tech companies are already reducing their workforce. Interestingly, their earnings are still strong. Normally, higher revenue should lead to more hiring and investment, but instead, companies are cutting jobs. This is because companies are reevaluating how many workers they need in an AI-driven world. In the past, a task might require 10 employees. Now companies believe the same work could be done by 7 or 8 people using AI tools. In many cases, companies do not immediately lay off workers. Instead, they reduce future hiring. Even if the unemployment rate does not rise sharply, job seekers feel there are fewer opportunities. And many jobs replaced by AI are entry-level tasks. This creates a closed system where experienced workers remain employed, but fewer new workers are hired. This makes it harder for new graduates to enter the labor market. The labor market works similar to financial markets. In economics, nominal GDP equals money supply multiplied by the velocity of money. Even if governments print large amounts of money, the impact is limited if the money does not circulate quickly. The labor market works in a similar way. Even if there are many jobs and workers, the market is not healthy if labor mobility is slow. A healthy labor market requires many jobs and fast labor circulation. But the U.S. labor market is slowing down because of AI, tariffs, and labor rigidity. Instead of circulating, the labor market is becoming stagnant. That is why the employment situation may be worse than it appears. Productivity is rising due to AI, but wages and employment growth are slowing. This creates an unusual economic contradiction. So why is the U.S. labor market important for investors? There are 2 reasons. First, the labor market is directly linked to the U.S. economy. Second, it strongly influences monetary policy. If the labor market continues to weaken, several things could happen. Starting in May, new college graduates will begin entering the job market. But if quit rates remain low and hiring stays weak, there will be fewer job opportunities. This could quickly become a political issue. Youth unemployment affects voter sentiment, especially in sectors like government, finance, and manufacturing, where turnover is already low. If these sectors stop hiring, it becomes harder for young people to find stable jobs. This could create political pressure before the November midterm elections. If that happens, the government may respond in 2 ways. First, expanding public sector hiring. Second, increasing fiscal spending. Both approaches involve injecting more money into the economy. Historically, governments have used infrastructure projects, defense spending, and public programs to create jobs. But these policies require large fiscal spending. That means more liquidity entering the market. The second reason employment matters is the Federal Reserve. The Fed determines monetary policy based largely on inflation and employment conditions. Historically, major bull markets in stocks and crypto often happened during periods of quantitative easing. Many people believe the next Fed chair will be hawkish. But if the labor market weakens significantly, it will be difficult for any Fed chair to maintain a hawkish stance. In reality, they may be forced to support the economy through rate cuts or quantitative easing. Let us summarize. The biggest risk right now may not be the Middle East war or the private credit market. It may be the U.S. labor market. If the labor market weakens, both the government and the Federal Reserve may respond with rate cuts and liquidity expansion. Ironically, that could create a major buying opportunity for investors during a downturn. From April and May, investors should closely watch the monthly U.S. employment reports. They should also watch CPI inflation data released in the middle of each month. If employment continues weakening, we may soon see stronger liquidity policies from the government and the Fed. In conclusion, most investors are focusing only on the Middle East war and private credit risks. But many institutional investors on Wall Street are already preparing for what happens after these issues fade. In the coming months, the most important indicator to watch may be U.S. employment data. If this video was helpful, please subscribe, like, and turn on notifications. This has been CoinCastle. Thank you.